Welcome to TradingMBI.com. This is John. This report is for the 18th of February. We had very clear lines as to what we were looking at. The ABM was just above the 38%. We had 44.40 for the 38% and slightly above. And already by the time pre-market came by, we had already dipped down to it. And that caused a flip as we got towards that ABM yellow of the magenta and white. The white started to move above magenta, and magenta was below yellow as well as below white, and that is negative. And you can see the exacerbation from that. A lot of reasons for it, but that's all speculation. What we can see is clearly where money just decided to change direction, and there we had the shorts popping up and a reversal back down of midterm buyers as well as short-term buyers fading in that, and when you're already in that weak state, doesn't take much of a catalyst to get things rolling. And you know, there's a logic. All the things the Fed has done really haven't fared very well. So an alternative construct is create volatility to reduce risk. And this is that leaving more of an ambiguity about where the Fed put is, where they'll support the market, how much of a decline, how much of a swings will they allow intraday. The larger those get, the more people are going to seek safety. And that in and of itself is going to be a market dampener. So there's that element of it. That isn't going to affect the inflation element of it, that they have to find other ways of containing. And Paul Volcker had one rule for that, for those that can remember that far back, and that's you raise interest rates, and that at least stymies activity, particularly. You know, you hear all these wonderful things about full employment and all that, but the reality is people have just stepped out of the workplace because of a lot of government inducement, and that has changed the economic dynamics. You've got a lot of counter moves. So the ideal situation is you pump oil up to reduce liquidity out of people's pockets, and then create the market volatility, and you create a double effect there because you both drain excess liquidity because of the additional commodity prices, which my expectation was always that we would have what would appear to be single mid-digit inflation, but in actuality double-digit. The problem with that is it can get out of control, just as it started to. But you do have an answer in reducing people's excesses by creating a situation where their regular income is reduced by the fact that you have these rising costs. The problem with that, though, is you need a significant influx of labor to keep wage pressures down, and that's, well, you see on the southern border, the problem is that's not really the dynamic of wage pressures that you want, while still keeping the economy moving. In Q, again, we talked about the 23%, which was 1404, and that's ugly. That bodes for a move to the 0% down at 13.7. So still another 460 more points to go, which would be equivalent to today's down move. It's going to happen overnight. It could, but oftentimes takes a couple more days. But as we've talked about, though, markets do fall fast, so much faster than they rise, 66% faster, for good reason. Once you start actually triggering where people have stops, and you end up with that lack of liquidity where people start thinking, maybe I'll just wait to buy the dip just a little bit, things get exacerbated. And as far as the euro goes, the problems that exist in the Eurozone are pretty much the same as they are in America, just a bit more compounded as we have this mix, just like in America, of states that have opened up freely, others that are not, and creates a lot of disruption from normal economic flow. And as long as that happens, you have uncertainty, and that has been causing the euro difficulties because there's no real assured guidance as to where things go. This is expected. Gold skyrocketing on that. And you also had the bombing in Donbass area, back and forth on who started what. And that's the whole point of what the term false flags comes from, where they're suggesting that one or the other side created it to try and generate the conflict, because that in and of itself would shoot oil up well over, towards the 150 marker, that would really start to put pressure on growth and slow things down quite a bit. So keep an eye on that. Here we have oil still maintaining. It's not quite high enough to create that kind of scenario, but that's where I would look for a breakout of that. And certainly war is the fastest way to do that. So you had a lot of people flocking back in towards treasuries, which that excess flow of money in there lowered yields slightly. Then you had situations like this where everyone was, talking about Bitcoin from a hedge. Well, you got gold skyrocketing and Bitcoin plummeting, and that's kind of because as we talked about, Bitcoin was sort of a duality situation where you could park some money against commodity rise at the same time, having a opportunity to take advantage of crypto space. But in this particular case, we know there are additional positive extremes lower than this, and moved back. Well, in this case, what was the low? We got down to 40,000 right here. So, and that's that magenta right there, that 39 that was a previous level from before that we had expected, at least from the daily. We haven't looked at the daily chart on that. I can pop that up real quick. And you can see, because we were in a nice upswing from the magenta being in the lead, and then it broke down below 33. That was the early warning of it. White had reset, but then you got that pivot, and boom, the drop below 25, and that corresponds with it beautifully from there. Also, you've had you see Cyan leading. Short's been ahead of it the whole way through. Just wasn't a strong move, and I like to look for those peaks of the orange. When they're settled below that 7.5, they get above that 7.5 is when you start to get more activity. You can see that happens in all these cases where we get these disturbances. So that's something to pay attention to when looking for that. ETH also very nice from its flow. Pretty significant declines in that one as well. And from our 50K, it went short early on. It should have gone even a little bit sooner than that, back over here when magenta tipped up and then pivoted back down. Literally was the optimal spot. It did it a little bit later. Equivalent price, that probably just fractionally better. And covered at the turnaround of magenta just popping above for that one brief bar right there. Talk to my code on that one and see about reinstituting those kind of situations where it immediately reverses back, sort of like what we call a spider effect when we're looking at like green rising above and then falling back below cyan. Creates that little diamond effect, kind of like that Black Widow. Intraday, pretty straightforward. We started off with that short signal that happened yesterday right after the close. It continued with the white leading into the after hours, and then that caused a little spark down, and then magenta came back above. That was enough to lift it for a little while, and then the white reared its little head, matching with the magenta right there, and magenta MBI was below yellow and falling, and then obviously reached the 25. Then we sparked back up a little bit, and that's when it just became a small series of huge white differentials with magenta dipping below. And for me, it's a strong indication when I see that happen, as long as I'm not getting some kind of uptick from it back above prior to the completion to the zero. But beautiful move to the zero. Did the exact same thing with the spike up here. Green was slightly in the lead at that particular point, and then by the next bar, boom, white clearly in the lead and magenta below 25, and that was really the beginning of lights out. And we stayed with the yellow hold line on any buys coming through. We had a couple of little pops where right there you can see magenta moved above white, was above everything. But with zero steel reset in this particular phase, a little too soon. We got a much better dip of it on a P2 setup right here. That flipped, and that one actually had a little bit of leg going forward, and with no white reset movement. Really wasn't until this later portion where it dipped below, but again it reversed right back up, but then did it right after that. And then it was just a matter of a few bars before the next leg. And that one took us all the way to the end of the day, and it was pretty clean going through there. Thought we might catch a little bit of a pop back up here as nice little buy yellow, but again, that one turned around pretty darn fast, even before the color was able to flip on that one, and brought us right back to the zero level again. And that's kind of where we're at. And we're 95 now. We were over minus 100. So, all in all, super exciting action, and I think that given what we're seeing, I think the potential for added volatility as a means for the Fed to really try and curb the market moves is a real possibility. Somewhere with that range between where we are right here in the 43s to down as low as 38, 37 range. Be interesting to see the reaction in those. I mean, it still wouldn't matter that much as far as a market move, given how far outside norms we've moved already. I mean, we're like 6 times deviation versus a normal situation. So there's plenty of room for a retrace of significant order without being catastrophic, so to speak. Gone a little long, but as always, though, a lot of information. We want to get out there and make sure that you follow along with that. Anything new and relevant, I will certainly put on Skype chat. Trade well. Talk to you later.